Welcome to this episode of the Modern Mindset Podcast. I'm your host, Josh Giordani. I got a special guest with me today, Joe Lima. Joe Lima has been in the real estate industry for a long time. We've been good buddies. We have a lot of mutual friends. He does a lot in the investing space. He is a hard money lender. So I'm sure we'll get into some hard money loans, probably talk about some kid stuff.
Love it. Yep.
Maybe politics. Who knows? We'll get into a bunch of different shit. So glad you're here today, buddy.
Hey, thanks for having me. Anytime you text me to come on down, I'm going to be there. So thanks a lot.
Of course.
Yeah.
I know we've been talking about this for a little while, but I've taken a little bit of a hiatus on the podcast. So
Happy to be on anytime.
yeah, it's all good. So you got into the industry, talked like your journey. Give me like a
Oh, wow. All right. Let's start from day one.
Sure.
All right.
Give me like a little breakdown. I actually don't even think I know like how you got into the industry. I know we got connected a long time ago when I was looking at a flip actually with one of our mutual friends, and we were going to partner together on it. And I think we got connected then, and you were living in San Francisco.
Yeah. San Jose Bay Area.
Yeah,
At
yeah.
that time. Yeah. It's been some time now. Yeah.
And then you moved out here, and now we've connected face to face. So it's been kind of a fun experience. But I don't know your history, like previous to hard money or loans or anything like that. So
I was started in the business, like fell into it. I don't know if anyone goes to school or goes and says, I'm going to be a loan officer. They just kind of, or a realtor for that matter, you just kind of fall into it, or you know someone that's in it. I started as an intern at San Diego State, and then our broker started paying us commission checks. So I was a processor, learned the ropes that way, kind of the back side of things before going on the front side. And made a small amount of money there, got my credit too to make sure I graduated, and then learned the sales side from there. And I think that internship was better than any class that I ever took. It teaches you real life, how the market's changing, how to deal with clientele, but it did teach me the sales side and ultimately how to structure out loans that are beneficial to the borrower through a refinance or through a purchase of their home. Which in turn made me move into the banking side of things. Went and worked on the conventional loans for, about 10 years. So after being an intern, so maybe 8 to 10 years of that, had a broker shop in Mission Valley, and then 2008 hit, and everything kind of had to reinvent myself. And that's when I kind of got into the hard money side of things. Was after that, and it was something where. Not that there's no emotion in the hard money deals, but it's more number centric, right? If you're going to go in and flip a property or go buy a rental portfolio, if the numbers pencil, it usually works, at least for the financing aspect. On the conventional side, you're dealing with Joe and Susie home buyer, first time home buyers, a family. They have to make sure the school's right, the house is situated correctly. So there is more. Even though I'm doing the financing, there's still more emotion involved.
debt to income ratios, credit score.
All that other side of stuff.
Yeah.
But I like the numbers. I want to make deals happen. And on the hard money side, you can have clients for life, which I've grown to have, in that they're developing or flipping properties, multiple times a year, and I'm a part of that transaction that way. So from an internship to having a broker shop to working a bit conventional and banking side, and then jumping into hard money. It was a little bit of a learning curve still, even though I was in the business for 10, 12 years at that point. And it's mainly from the construction aspect. So I knew all the numbers part of it. I knew how to structure out a deal and make sure it's the financing aspect and how to approve it and how to make our fund comfortable with it. But it was learning, what part of the rehab or the construction is going to make that property worth more in the end. Mm-hmm. And I was kind of learning on the fly there. So there would be times where, I used to, at one of the shops I worked at as a small family office, and we didn't have a draw team. I was the draw team. Mm-hmm. And I didn't know shit about construction. So, I could barely hang a picture on the wall. So I go over there to like check out the guy's framing. I had no idea what framing was. And then I just told one of the subs that was there, I got to look at the framing. And I start walking around the house, looking at the baseboards, and I had no idea. And he starts pointing it out. He's like, this is the structure of the house.
Taking pictures of the baseboard, uploading it to the system.
Well, they didn't even have baseboard at that point, but I'm looking where the floor went into the side,
right?
Whatever. And I'm like, oh, duh, framing is the frame of the house. Mm-hmm. So that was part of the thing. So I started to look up, terms and make sure I knew what their draw was asking for when I went out there instead of just winging it. But I guess the point of that is always looking to learn new things. And that was something that I had to master to get into where I am now, as far as, major developments and doing, ground up construction loans and even the small rehab loans and all that. So yeah, the big learning step.
Love that.
To go from there.
And then you moved to San Diego now. It's been like 3 years now.
Yeah. Well, I was down at San Diego State prior to
Right.
08. 08, my wife and I moved. We're both from the Bay, so we moved back to the Bay Area. So it's been down in SoCal, back in SoCal for 4 years.
Okay.
Yeah.
Cool.
Yeah.
What are you seeing right now in the market? So it's we were just talking about this before you stepped in here. This market cycle over the last 2 years has been a roller coaster.
Yeah.
We're seeing, like, from the traditional buyer side, Fed rate cuts, but everyone thinks that rates have gone down, but instead they have gone up, which has been the opposite.
Yep.
For those that don't know, that the Fed funds rate is where institutionals lend each other money, and it is, but it isn't correlated with mortgage interest rates. And normally mortgage interest rates is priced in prior to the Fed making a decision on rate cuts. What have you seen when it comes to hard money rate? I haven't seen, like, in terms of my hard money loans, I haven't seen an increase in my rate. I haven't asked for a rate cut. I'm sure I probably could have over the last few months, but
We'll talk about that after.
yeah. What have you seen in terms of, like, rates with traditional hard money? Have you guys been increasing? What is the institution seeing?
We've been on a sharp decline over the past 2 years. I mean, there was a time where, like I'm talking about fix and flip loans, construction loans, where every lender in my space was around the same. You're talking like a quarter, half a point difference here and there. So it wasn't a major difference. But those rates over the past, in anticipation of that rate drop, those bridge construction rehab loans came down a little bit too. I haven't had any increase to come back up like a conventional rates have been. But where they're at right now, you're seeing around a 10 to 10.5 is probably fair. You get some lenders that can, if they have a super experienced borrower, you're going to be in the mid 9s, still going to be paying a point or so. There's some lenders out there that, can even get lower than that with their own funds if they really, really like the client, want to keep them on board. But as a conventional type rate, I mean, you had Joe and Susie Homebuyer banking on that to afford the house that they wanted to go buy, right? So they've been waiting. Oh, the rates are going to come down. Rates are going to come down. Rates are going to come down. And then the Fed dropped the rate, half a point. And even I was getting calls like, "Hey, I have that bridge loan in process for 10. Can I get it at 9.5 now because the Fed dropped the rate?" I'm like, "No, this is," and they already had these kind of baked into everything. What over the past 2 years, you heard some realtors go out there like, what was the slogan?
Date the rate.
Date the rate, or marry the house, date the rate. I wonder if we can go back and, like, see who did that, because there's no way you're. And my take is, you shouldn't be buying a house based off of, hey, it's going to get lower in costs later down the line. You should be comfortable for where you're at that point of buying the house,
100%,
and not thinking, oh, I'm going to just refinance later and I can, it's going to be a struggle for the first year, and then when the rates come down, I can stay into it. I'm hoping that doesn't turn into anything bad down the line from, like, a foreclosure standpoint, but that was just something I could never get behind, because you have no idea when and how much the Fed's going to knock down a rate, if even it's going to have a positive effect on the rates, meaning a decline in rates for the consumer. Because, like, look at this, we just had a half a point, which I thought was going to be my crystal ball. I thought they were going to do a quarter point, and they did a half, great. But then now we're kind of at the same boat where they were 2 years ago.
Right. And now we're at the highest that mortgage rates have been in a long time, since 4 months ago at the high. I think we're at the highs again. It's been interesting. I see a lot of people date the rate, marry the
marry the house, date the rate.
No, it's the price.
Marry the price.
Marry the price.
Marry the price, date the rate. Whatever, something like that.
Saying, but anyhow, and I still see people all the time predicting that interest rates are going to go down. Historically, of course, they're going to go down eventually. Do I think they're going to go down in the next 2 years? I don't know. And a lot of people in those predictions on what Goldman Sachs comes out with, or Redfin, or Zillow, or all these places, I don't know that I necessarily believe in that trajectory. And over time in history, what we've seen with interest rates lower is something traumatic to our economy.
Correct.
And we've seen it in 2008. We saw it in the dot-com bubble. We saw it in the pandemic. Those are the last 3 times that interest rates, the Fed funds rate got close to 0 or to 0, which obviously impacted mortgage interest rates, and they've lowered extremely low. But I don't see 3% anytime soon unless we have some catastrophic event to our economy.
Yeah, correct. I'm with you on that. And my take is if the dust settles and we end up for consumer side, not hard money, but because I'm indirectly affected by that.
Sure.
But the consumer side, if they end up somewhere in the 5s, it's fair for everybody.
For sure.
You know, if you're quoting a 4.99 interest rate on 30-year fixed, that is outstanding. If someone thinks that they're going to go into a house and there's going to be some catastrophic event and they're going to get down to a 2.5% 30-year fix, forget about it. Don't do it.
Yeah. Go ahead.
Yeah, I was just going to say that if someone is going into a fix and flip project, for example, and they're looking to sell the thing in 6 months in anticipation of, the rates are going to be down there, we're going to end up with more of a profit because there's going to be a buyer frenzy at that point in time. Shouldn't be doing that either. So that anything that someone is doing is in how do I say this? In a project, in a rehab project, a construction project, purchasing their own house, they shouldn't bank on rates in any sort of fashion. If they lower, it's a bonus. Awesome. Great deal. And what I've learned through all this is whether it's someone that's prognosticating sports or they're, picking a draft pick, or if it's some person on CNBC or Bloomberg that's, spouting off about when and where rates are going to change. Nobody knows shit.
No.
They all have their opinions on when it's going to happen and when it's not going to happen or how much it's going to be, and nobody knows until it happens.
No, you can't predict it. And the thing is that the market is a slower moving, like the real estate market in general. So predicting some type of a fallout or anything like that is a fool's game. But I do think the only thing that really can control that dramatically is where interest rates are, which can then put a halt or a slowdown in the market. And we've seen that over the last few months. That could also have to do with the election. One of the things I actually posted this on my story today.
That's what you're doing on your phone.
Yeah. So I just want to share this because we were talking about, I think it's important for any investor, right? If the majority of people, if they're listening, consumers and investors, I have to think like a consumer as well when I'm making an investment decision when it comes to flipping houses. Because what is the consumer doing when I'm buying this asset? Am I going to be able to resell it for what the current market value is? Or are we in a depreciating market where the consumer is pulling back? Is interest rates going higher? Is inventory going up? So those are all factors that I have to watch for. Yes, like our side is definitely more business numbers driven, but we still have to keep the emotional aspect of it in our minds of what the economy is doing and what the consumer is doing to make a valid decision. So one of the things I posted this today, U.S. incomes spiked to 60%. If the U.S. income spiked to 60%, we'd return to pre-pandemic affordability levels.
I saw this. Actually, I saw it on your Instagram too. Keep going, yes.
If U.S. home prices fell 38%, we would return to pre-pandemic affordable levels.
Okay.
And if rates fell to 4.15% from 6.5%, we'd return to pre-pandemic affordability. That shit is crazy.
Yeah.
38%.
38%. So even though I just said nobody knows shit, out of those 3 things, what was the first one again? The wages have to increase by what, 60%?
60%.
Okay.
And then home prices have to fall by 38%, and rates have to drop. Excuse me, rates have to fall 4.5%. So they have to get down to 2.23% in order to reach pre-pandemic.
I thought you were going to say they fall to 4%. I'm like, out of the 3, the last one is the one that could
2.3 makes sense. Yeah. It's crazy.
It can get close, but that is nuts because in my crystal ball, I don't see any of that happening anytime soon.
No.
Unless we go to World War III, which I don't want to happen.
Obviously. I've been paying a lot of attention to other markets because I feel like we're not lagging behind in California.
You're talking about outside of California?
Outside of California.
Oh,
yeah. So like Florida's getting hit. They're starting to see depreciation in their market. Their inventory levels are spiking. You're starting to see that in certain parts of the Midwest. And there are other areas of California, not necessarily specifically San Diego, that are getting hit. But those are interesting because where and when do we fall in line to that, or when do we catch up to that? And that's a big question mark I have, because I do believe that we will get to that place. And we are obviously a great city and people want to live here, but at some point we are going to get to an oversupplied market, because that's what's happening in Florida, right? Florida is an oversupplied market and there's more inventory going on the market, where right now we are increasing, but not increasing at the pace that they did.
You still need the economics of the city, town to work out for that supply and housing, right?
Yeah.
Because you see the main headlines of there's a shortage of housing, need more inventory. Well, I'm not saying they're going to solve the whole problem, but developers and flippers are helping with putting more inventory out in the market. But then I guess your question is, when is too much inventory? When's that balance going to be there? Because if rates stay steady of where they're at, there's not going to be there. We see it. There's not as many buyers out there. The buyer pool is shrinking. So where does that inventory number need to be to make everything work and keep flowing, right? Because you don't want to have a depreciation situation like it's happening in Florida. I've seen it, and there are the Midwest portion of it. But still, I mean, Midwest, there's still some hot markets out there, because just from a cash flow perspective,
Sure.
I don't know the answer to that question.
No, I don't either. No, it's just a conversation.
Yeah.
I feel like it's something to pay attention to. And like, I didn't have a crystal ball 3 months ago. I was buying deals pretty tight. You know, normally my minimum is like an 8%, gross margin or net margin. And, I was taking on some like 5-6% condos that were going to be like quick. I thought in and out in 60 days, looking at the inventory, there was no inventory. I was like, cool, I'll move these super fast. Those are the ones I'm losing money on right now, or breaking even on. Right. And you think that things can't happen that quickly, but they can happen quickly. And a 30-day period is a long time for in a specific community, 10 houses to come on the market, right? When we've normally had like 1 or 2 or 3. So it makes it interesting.
For a developer or a flipper, you're looking very short term at the market, right? Because like you just said, in and out in 60 days. You want to make sure everything holds together for that 60 days so you can make your profit. The thing about real estate, though, as we've seen throughout history, is that over time it's going to always go up. So we're in a if you're looking at a graph, we're just kind of in a straight parallel line, or maybe a little bit of a lull in it, but over time it's going to go up. So we look back from 10 years from now, the prices that we have today should be higher than where they were, right?
Well, yeah.
So the whole thing about, if you're a consumer going in and buying the property, that's a great move, no matter where you're at on the interest rate, because that asset should be increased in value when you leave it at some point down the line. But where I'm getting with this is, it's hard to, I guess, part of the difficult aspect of being a developer or a flipper is the timing. And you just don't know what's going to be down the road, especially if you're doing a heavy project and, say you're doing a ground up and building, 6 houses. When those hit the market in 18 months, where is the market going to be? And are they going to be underwater or not? And you can do your best to use your crystal ball and prognosticate, but you have to still, bank on it, bank on the product you're selling, and making sure that product is going to be something that people are going to want to buy.
Yeah, I think I kind of changed my buy box a little bit the last few months. I'm not taking on any heavy major fixers anymore. Most of those, as long as they're direct to, I'm direct to seller, I'll probably assign those. I want, really some cosmetic, nice neighborhoods. Dealing with a lot of break-ins right now, so don't want shit in the ghetto.
I saw that.
Yeah, but they broke in a second time. So, it's just dealing with this roller coaster waves of like trying to buy in areas where people and affordability makes sense. And you have the high, like good school districts, like all those things I think are important now to look at more than ever. Because I do think we're on this weird razor's edge, like we can see a recession if we're not already in one. And real estate can get affected and will. Like if stock market goes down, people will still hold back on buying decisions. A lot of people have money tied up in 401ks. Those will impact. Higher interest rates will also impact with higher credit card debt, things like that. Like all those things are playing into a factor right now. And I think, one of the things that I think is that we've just ran out of buyers who can afford the prices that we're in. And there's just not a lot of people who's making a lot of money, or they're getting laid off.
You get that I don't know the exact number, but I'm being general here, but you get that buyer between the, 1.5 to 2.5 is going to be more effective. The middle class buyer in California is going to be more affected where the interest rates are because they're trying to piece together that move up house, right? Someone that's someone that's purchasing a $5 million plus or $6 million plus house is less is as cautious. I'm not saying less is cautious. Less is stringent about what type of interest rate that they're getting because they're just looking to just buy that house because they want it, right?
Yeah, totally.
And then someone that's below that 1.5 mark is just happy they're getting into the place. So I get
those people are also really affected by interest rates too.
Correct.
Yeah.
Correct. Every dollar counts, I guess, for everybody. But at the same time, if it's not that quarter point, so they can afford it from a DTI perspective or even just a real life perspective, they're not going to do it.
Right.
But what I'm getting at is the majority of the homes here in a significant area locally is going to be in that 1.5 area, and that's where you can probably see the slowdown. But for me, lending in 36 states and DC, I'm seeing different. That real estate truly is local, depending where area and what type of product that developer or flipper is putting out there. You build up a name for yourself as a flipper or developer. It's going to attract more people, and still having bidding wars in certain areas. But the common theme I'm seeing, it goes back to this inventory, is the municipalities and cities are all looking at density plays and different ways to chop it up to put more inventory out there. So it goes back to what we were saying as far as where is that line of how much inventory you can have out there, and then it goes back to what type of economics jobs are in that area to drive people to live there.
Totally. Yeah, and I think overall too right now, I mean, I'm sure you've seen this with anytime like jobs reports comes out and all those things. Like I can't even predict the market because it's always getting readjusted.
But yeah, I was just going to say that. They'll say, oh, the job report is at whatever 4%, 4% unemployment, and then the next day, actually, is corrected is 3% or 6%, whatever the freaking number is.
Dude,
but it's never it's never what it says when it's announced.
No, and then they don't talk about the adjusted shitty number after it was announced. And that's the hard thing too, is like right now we're in an election year and we're 3 weeks away from an election, and we're having all these numbers getting adjusted worse when we get these unemployment numbers that come out, but they don't talk about the unemployment numbers when they get adjusted. It just goes to
It's going to be interesting to see how this all plays out,
I
right?
know, man.
I try to not watch the news, but then it's kind of like not watch it. You have to, especially right now, just to see what's going on. But I don't believe anything that's out there.
It's hard, man.
One headline to another, you don't know what's the truth anymore. It sucks, but that's the reality of it.
And like politically, each news outlet is different politically.
Correct.
Right. One's gonna be sided more towards a positive Democratic headline. One's gonna be more Republican positive headline and a negative Democratic headline. So it's like you pick your poison. But if you're a Republican, you're probably watching a Republican news channel. And if you're a Democrat, you're probably watching a Democratic news channel. So but what's the truth? There's no middle ground, right?
Nothing.
So
you have to go research it for yourself.
Yeah, but even then, like the research, I feel like unless you're pulling up actual legal documents or articles that you're having to sift through, it's fucking lies.
It is. You kind of read through like different articles and kind of figure out what seems to be the truth. I'll tell you what, for me, I didn't really see this as a problem. Talking about news media stuff.
Yeah.
Like pre-COVID, I just took everything whatever they were saying, like, okay, this is somewhat accurate.
Right.
And then COVID come out, and it's obviously we had those conspiracy theories and this and that, and it's crazy how more and more of those turned out to be true. But I think there was a point during I think it was during COVID or maybe just before it where Trump got impeached, one of the first ones, and my wife and I were sitting there and we're going between Fox News and CNN, and like CNN was saying, Trump could be out of the Oval Office by tomorrow. And then you turn to Fox News and they're like, "What, is he really impeached? Like, is it like both sides were not even close to saying the true story?
No,
what was happening?
Yeah, it's a hard thing.
Came to the realization just to not watch any of them.
Yeah, you can. And I don't know. Like the government's not going to save anyone.
No,
like we're in a fucked up election right now because our economy is terrible, and I do think that we need some. We do need some change, and I'm not getting like political, but change needs to take place right now.
At least from an emotional standpoint, like to have some type of way to people to feel more comfortable on what the future holds for somebody.
But someone would say that they're not going to feel comfortable if someone's elected.
Correct.
So that's
Correct.
kind of a fine line when you say emotion, but it's economically we need someone different.
Yeah.
You know, and we need to change and where our economy has gone with you know the current president. But I don't know, like I am curious to see what happens after this election, to see if the dust settles, to see if the market kind of picks up a little bit. Because I think this year, with being an election year, you know, it does tend to slow down like historically. Will it pick back up next year? Who knows, right? It's kind of
Nobody
an interesting
knows
thing.
shit.
Yeah, no one knows shit, exactly.
But even like in my days doing conventional loans, and even today, there people whenever there's an election year, they'll hold off from making that big purchase, or they'll hold off from getting to the next project until after the election. I don't know what side makes them determined to go buy the house or not, because those people that were holding off until after election still went and bought a house months later, from what I remember. And the flippers that were out there, contractors, you know, they held off from buying something. Then after the election, they still went and did more projects. So I don't know what psychologically was in their head from one side to the other, as far as, you know, Republican, Democrat, whatever they needed to have done for them to move on and with their business. It needed to happen for them to feel okay about it. But at the end of the day, no matter who's in office, you still have to go out and do the work, make shit happen. Go find your next flip. I have to go find another loan. Its business still needs to carry on,
100%.
no matter who's there.
Yeah.
And not blame it on who's in the other side of the country and sitting in an office. Shouldn't be the case.
No, you got to blame it on yourself. If you're not doing what you're supposed to do, it's not the president. The government's not going to save you. You got to get your ass to work.
Correct.
So, honestly, right now, talking about deals and maybe people taking a pause or trying to figure out or wait or anything like that, like I'm actually seeing right now, and don't get me wrong, I have nerves too, right? And going in, I think we all can think what the worst case scenario for next year. I'm cautiously optimistic is how I call it. But right now, even what I'm seeing with my deals that are on the market that I'm reselling, that I'm not getting what I expected on, I'm seeing also some really good deals on new acquisition side. And I think right now is probably a great time to pick some things up at some steeper discounts for the fear of the fact that we're going into an election and no one knows what the fuck's going to happen next year. And so to me, it's like, I want to buy some really good deals, maybe not ones that are time constraint or heavy fixers like massive mold or foundation issues, but you know, some like cosmetic stuff where I can get some decent spread on it. That's maybe a little bit more than just my traditional 8%, where I'm competing with a ton of other flippers. You know, that to me, I'm willing to take that risk going into next year. And I can't stop buying because that's my business model and my business. But yeah,
What's the saying? Scared money don't make money.
Yeah.
Well, don't be scared. Go out there and do it. I mean, that there's opportunity out there in every market that has opportunity that's there. But this one, from my side of the desk, I'm seeing more veterans in the business like yourself that are taking advantage of the opportunity. Over the past, I'm going to say 18 months, a year, the calls for the people that just took the flipping course, went to the conference, and now wants to get into their first flip, those have really, really subsided. I mean, at least from my phone. I'm not saying that they're not out there. If you need to go do it, go do it. Get off the couch, go flip a house. Great. But they may be scared or maybe don't want to take that leap because of all these extenuating circumstances that are out there. But for someone that's trying to get into the business right now, it's not the easiest, but there is the opportunity because you're one of the rare people that's stepping up to do it.
Yeah.
So someone like what you were just getting into about maybe taking on something that because you're not scared or because you're cautiously optimistic is better than someone that's just sitting there waiting for everything else to happen before they get in and it's too late.
Yeah, for sure. There's a lot of people who I've heard things from where they like take a pause or the market shifts on them and then they stop buying, but then they miss those big opportunities that come through. I think that's why consistently buying over time, I don't feel like it's, you know, someone would call me a gambler for buying real estate. And it's actually
Every-
my dad calls me a gambler.
Everything's a gamble.
Yeah.
Everything in life's a gamble. You're betting on the market for housing to buy now and sell it at a higher price later. If you were to go buy a stock, you did all the analysis on XYZ stock, and you go and purchase 1,000 shares hoping to make a profit on the thing a year later, the company can go bankrupt. Everything's a risk.
Yeah.
You go put $1,000 on the Niners next week. Hopefully they beat the Cowboys. But I'm dating this on this thing, but hopefully they win. Great, you make your money. If not, you're losing. Everything's a freaking gamble.
Yeah. See, I feel like it's calculated risk with real estate because, like with me, obviously, I'm looking at what has sold in the past.
Mm-hmm.
For the last 6 months, what would an appraiser appraise this property for fixed up, right? If it's worth $1 million and I can pay, and I can get it at $700,000, I put $100,000 into it. There's enough spread in that thing for me to make a fucking mistake, right? So for me, I'm open to making the mistake. But to me, I looked at that like I just bought a stock on sale.
Mm-hmm.
That like sold off for no reason that I'm buying at a 70% discount.
You already made your money. You bought it
Yeah.
at the right price.
Right.
That you made that money. You can go put it back on the market and make a smidge. You
Yeah.
still made some money.
Yeah.
It's like cashing out early on your parlay.
100%.
You
Yeah.
still make some.
What do you let's talk about some rentals. What are you seeing right now? We were talking about DSCR before.
Yeah.
DSCR?
Yeah,
DSCR.
debt service coverage ratio.
Yeah.
So the basics of those loans, property has to cash flow or at least break even off the rents. I have my pipeline right now. I was just going through it with my processing team this morning. I have 0 DSCR loans in the state of California, 0. And it's not because I don't know anybody or there's people that don't own rentals in here. Just those loans at 7.5%, 8% rate, whatever they're at, are not cash flowing in California because of the property value compared to what the rents are, and the property taxes compared to what the rents are, and the insurance compared to what the rents are. We talked about Middle America earlier. You go to Middle America and they're still cash flowing because the property is $200,000 versus $2 million.
Mm-hmm.
Now you're not, going to buy one single family residence and, call it retirement and go, hey, I'm just cash flowing off this thing. You're making a couple $100, $500, $600, $700 maybe tops.
Mm-hmm. Right.
You have a water heater go out, you're screwed. You're screwed for a couple months in your cash flow situation. But out of state, in certain pockets of out of state, are still great for rental investing.
Where are you seeing that?
Ohio, there's a couple cities, Columbus, Cleveland, Cincinnati. I know they're, you can say what you want about the sports teams there or whatever, but the city's cash flow. Oklahoma. You get right outside Oklahoma City and like the residential areas about there. Boise still works. Maybe not just direct in Boise, but out, some proximity outside of there.
Mm-hmm.
I have one borrower out, or 2 borrowers actually in Louisiana, and they're following the BRRRR to the T. So the buy, rehab, refinance, repeat.
Mm-hmm.
They're following it to the T, and they're putting in X amount for a flip. They're refinancing out of it, getting all their down payment back. And then they're cash flowing on the property, and usually it's a single family or single family duplex, and they have 1 triplex that I can remember correctly. But they're, in a sense, they've built this like little mini portfolio of like 9 properties, and they all have like 0 money out of pocket after they've refinanced everything. Again, outside of California, they're cash flowing, and it's making it make sense out there.
Yeah.
If you have in California, it has to be multi-unit to really make it work. Unless you have like 50% down or a relatively low loan amount against it. But for real estate investors, they love the leverage, so they're not going to have that much equity in the place.
Even with 50%,
it's still tough.
Yeah.
I just threw that number out there.
Honestly, I think I was running the numbers on my the condo that I have. And I bought it at 465 and it appraised at 910. I put very little into it. And my rent's 3150. So I would have to basically, let's just use round math. Like my loan amount would have to be just under right around 300,000 in order for that thing to cash flow.
Yeah. That's not even including the taxes and insurance too. You have to make sure that's
HOA.
And HOA.
Yeah.
You have to factor that in.
Yeah.
I work with mortgage brokers too. And mortgage brokers are great. They're great for the client, all that stuff. But sometimes they'll call up and go, hey, I want to do this DSCR loan. They're buying it for $2 million, going to put 20% down. And I start running numbers. I'm like, this thing's going to have to rent out for $18,000 a month. It's just some regular house in the middle of
Right.
suburbia. It's not on the water or anything like that. Oh, it can make it work. No, it can't. So they can't. They're just not penciling to make it work at that aspect. But you go off market rents or the actual lease that's in hand. If the lease is in hand, it's going to trump any market rents because that's what you're actually getting paid. But they have to take into account, like we just said, the mortgage payment, the property taxes, and the insurance. And if there's an HOA, you have to put that in there because at the end of the day, you want to make sure that the borrower, owner, investor is breaking even on that
Right.
to make sure the loan is getting paid for.
What do you do multifamily lending?
I go up to 4 units right now.
Okay.
You know, one-offs on the like 5 to 10 kind of stuff.
Do you have an opinion on the space right now?
I think that if you're in a major metro area like San Diego, LA has very similar to what the ADU plays. You have the Transit Authority down in downtown. LA is something similar. I forget the name of it. But I like those. You're building a 4-unit, 5-unit, 10-unit without actually building a 10-unit.
Mm-hmm.
I don't know what the aesthetics for the neighborhood are going to be like or if your neighbors really like it. But from a pure cash flow perspective, they work. The common theme I see in different markets is the city, the township. They're all about density.
Mm-hmm.
If they're in a city, if they're in a major metro area, they're all about the density and they want to have more housing. That goes back to the inventory portion of it. So what do I think about them? I like them. I think they're a good option for investors because it's helping to solve that cash flow problem.
Sure.
So if that property was just a single family, not cash flowing at all, they put 3 ADUs in the back. Okay, now you're working and you can hold it be a landlord and hold the property.
Yeah, I had one earlier this year where it was good zoning, okay lot. There was a slope, so I didn't love it to keep it to do the project. But I think we could put 17 additional units on
17?
17.
Oh, shit.
Yeah, 17 units on a single family lot. And after it was all said and done, it looked like based on paper, I think it was only going to cost us right around 1.7, somewhere between 1.7 and 2.2. I don't remember the exact figure, so don't quote me on it. But it maybe was a little less unit, maybe it was 10 units. But on paper, it looked really good, it looked solid. But the problem is like you get to a point where a lot of those you can only do once or studios.
Oh,
And it's like, how often do you want your turnover for new tenants? So like I have my condo as a 1-bedroom and I have turnover every single year. It's a new tenant. So I have to do cleanup. I have to do replace shit or fix shit or whatever it is. With 1-bedrooms, I feel like your turnover on your 1-bedrooms are going to be pretty consistent, which would be more of a headache. So for me, I feel like anything that I would love to find something on a big lot that I could do that, like do a project like that.
Mm-hmm.
I would like to start doing like one of those a year. Bring in a partner, find one of the good quality lots to build on and start building up kind of like that portfolio.
Then hold on to it?
Yeah, for a 5-year period, then 1031 and out of it. And just keep doing it every year. So I have like this nest egg of like 1031s that I can keep stacking
One of your
up.
partners might be able to keep that if they want to.
Or keep
it.
it. Keep it. But ideally, it's nice to get into bigger and bigger units.
Mm-hmm.
So, yeah.
I will say that just doing this as long as I have, I have borrowers that have started as a flipper and maybe done some, like you're talking about basic cosmetic flips or something like that. They started there and then now they're doing these bigger development plays, whether it's chopping up a lot and building 4 houses on it, or they're have enough to build some ADUs, turn into multifamily construction. But where they all kind of filters into is the multifamily play,
Right.
and having that available for them because that's what investors want now.
Yeah, for sure.
And if someone's going to invest to be a landlord or have built up a rental portfolio, they want the multifamily in there because that's where the rents are going to keep generating and helps diversify it.
Mm-hmm.
What I am seeing on this whole rental market is the person that's just going in and buying a turnkey rental is very rare right now. They're either fixing it up to hold it or they're getting into a multifamily. If they are buying it a turnkey, it's a multifamily type play.
Mm-hmm.
The single, buy up 10 single family houses is not really happening too much. At least what I'm seeing.
Yeah, I feel like it would be so hard for me not to buy value add.
Yeah, I know. Cause then you have to, it goes back to buying it at the right price to make your money. And if you're buying it something on the MLS going, oh, I'm just going to rent this thing out.
Well, there's a 3% cap rate.
Yeah,
It's not, it
it's
doesn't,
not gonna-
doesn't
not
wake
gonna
me up
pencil.
in the morning.
No, it's
yeah,
not.
it doesn't
not
get
cool.
my pencil excited.
No.
Yeah, I mean, I don't know. Like, obviously, there's a lot of people who just park their money in those big deals, but also too, of course, there's big cost segregations. Like when you're buying those big multifamily deals, like the cost segregations and the tax benefits that you can do on something like that far outweighs what you can do in single family.
Correct.
So I think a lot of people with big money, that's why they diversify in that. They don't care about the 3%, 3% or 4% cap rate.
just
They're
park it.
like, hey, I parked this cash in here. I bought this $20 million building. Let me cost seg this thing and take off $1 million or $2 million of my active income. So to that, it makes a lot of sense because that $2 or $3 million is probably a pretty big deal when if you added that into your cap rate.
Well, in that regard, I'm going to defer to you.
With what? Oh,
Do you have any segregation?
Cost.
Do you have any syndications that you've been working with on that kind of stuff?
no, I haven't been doing any multifamily stuff yet.
No?
No, I think with the operation with the flipping and wholesaling right now, I'm just trying to get this thing to a well-oiled machine. And my goal is to like, hey, if a deal lands on my lap and it's a good deal, I can already raise money for flips. I could probably pretty easily raise money for multifamily as well. And then bring on partners. Like if it was money, but bring on a partner for money. And then if it was someone who does multifamily, bring on a partner for multifamily so that I can collaborate with all three of them. We all are limited or partners in it and, move the needle that way.
Because there's this whole other side of the business. I mean, we're talking about hard money loans and flipping properties, but then there's this whole other side that's getting into syndications and raising money to then go in and buy these multifamily properties, right? I have some borrowers I worked with from time to time that they will use me for the bulk of the financing, but then all their down payment for what XYZ project is coming from some sort of syndication. However, they chop it up, if they make an LLC out of it, or they just have a fund that's coming in with the money. I am seeing more and more of those out there from these bigger groups that are kind of coming in to ultimately build up a portfolio of what you just talked about, where they have these constant cycles of apartment buildings or multifamily buildings where they're 1031ing them into another project later down the line and keeping some of the proceeds.
Yeah.
But
Makes sense.
It's just something that it's ever evolving, I guess.
It is.
And it's something that, going back to what we were talking about, interest rates being, at 5 or 6 or 7, apartments are still there, and they don't really, they're always going to be rented out no matter where the interest rates are going to be at. There's going to always be someone that needs that rental space, and that owner investor is going to reap the benefits of that.
Yeah. The only thing I see, that's why I was asking about commercial stuff and what your thoughts were, is that a lot of those people who bought during the pandemic with really low interest rates that have to now refi after 5 years.
I haven't ran into any of that yet.
I'm hearing stories.
Yeah, you are?
Yeah, where people are having to put significant money down in order for it to pencil for another 5 years. Because if people don't know that are listening, commercial loans, anything above 5 units, you have to get their 5-year terms, right? Their 5-year loan terms. So when you're penciling in your figures based on lower interest rates and you're doing your projections for the next 5 years, when you have to go refi in 5 years, and now all of a sudden when you're refining, you don't have a 4% rate anymore, you have a 7 or 8. Makes a big difference, especially when you're buying a tight deal. So then these people are having to put millions of dollars down, but if they're a mom and pop investor, they don't have it. So what do you have to do? Then you're selling it at a loss, right? Because then the next person's going to come, they're going to do those projections, and they're going to base those projections off of exactly what you're looking at, but you're going to take the same loss that you would to have to put the money down to refi. So there's some interesting.
I've yet to have someone. I'm not in that space. Like, that's not my niche.
Mine either.
But something I need to pay attention to more. So I'm learning something here with your podcast today.
That's why I'm paying attention to it right now. I just feel like it is a kind of, it's not being overlooked. I think there's a lot of commercial guys who I follow or who I've spoken with. Some people close to me who have been talking about it. And to me, anytime when there's kind of, sounds bad, blood in the water, I think it's, you kind of got to be a little bit of a shark and look at those opportunities. I think I was in the market in 2008, 2009. And, at the time there was communities that were doing seller financing, like DR Horton and these builders were doing seller financing terms for 30 years. And these houses were like $100,000 back in the day. And my dad was like, you should go buy this. So I wrote up the contract, was making an offer on it. I was a 19-year-old kid, didn't know what I was doing, and I didn't buy it. Now that house is worth $600,000, right? And to me, I'm like, that was a missed opportunity. If I would have known what I know today, I would have not have missed it. So now I'm looking at other opportunities. And unfortunately, like when I say blood in the water, it kind of sucks because there is someone hurting at the other end of that. But
yeah, but you're there.
It is what it is.
It is what it is.
So, but yeah, I definitely have my eyes on it.
Hindsight's always 20/20.
It is.
You can always look back and wish I would have kept that house or this house or whatever.
Yeah.
Wish I would have kept my house in downtown San Diego, but whatever, it's gone.
Yeah.
But at the same time, there's always opportunity out there.
Yeah.
And just like the commercial example you brought up, that's something that I've heard about it, just haven't like really paid attention to it because I'm stuck in my little bubble as far as the flip and development plays.
Same.
But it's something to I'll keep my radar on about.
For sure. Yeah. Anything else that we were pressing that you wanted to?
I don't know. I think we went through like
a lot. We went through pretty quick.
I feel like I was on a freaking economics course of some sort with my dumb ass talking about stuff, but it's all right.
Yeah. No, it was fun though. I mean, yeah, it's all good stuff. How much time? What are we at? What time?
50.
Oh, wow. See? Fucking A.
5-0?
Flew by.
I was thinking I wanted to look at my watch. I'm like, has it been 15 minutes?
No, we're good. All right, cool. Well, any closing thoughts? We want to wrap it up?
Go buy your next flip. Get off the couch and go do it.
Go use Joe for it too.
Yeah, it'd get me.
Thank you everyone for watching. Please make sure to like and subscribe. Joe's information will be below, and we'll see everyone on the next episode. Peace.